Welcome to the Artisan Podcast, where we share insights from the world's leading investors and strategists. Today, we have one of the world's top macro strategists, who just happens to be my brother, David Abramson, the US strategist and director of research at Alpine Macro. Enjoy. So in the age of AI, I have to ask the question that I ask all of our guests. Are you a robot? Well, you are my brother, but are you?
I don't think there's any way to tell just yet. Let's see. After the end of this interview, let's get the listeners to vote.
Well, if you are a robot, you're a pretty insightful one. Let's get down to brass tacks. Tell us, Dave, how low are U.S. rates going to go in 2024?
So 2024, I think, is going to be the year where we spent much of this year, I don't know about the listeners, but most of the people out there, analysts like myself, waiting for the US economy to slow. And I think 2024 is the year where that slowdown actually happens. And so we can talk about which of the two typical slowdowns comes out, both of which are ultimately mild. One type of slowdown is where the Fed watches it happen and it really looks like it's getting out of control for a short period of time, but then it's okay. It's not a meltdown in the economy or a 2008 global financial crisis. And then you get a V shape in markets and interest rates going down quite sharply. That's the answer to your question. The other, which I think is more likely, is we get the economic slowdown that most people expected this year that did not happen, and we can talk about why. We get that next year. And in that case, people forget that any kind of a recession, even if it's from very low level of of unemployment rate, you get the Fed cutting interest rates. And I think that's what we're looking at next year. And so I don't want to put an artificial number on it, but I think it's a relatively safe bet that 10-year bond yields will get down to 3%. If it's more of that V-shaped scenario, then of course they go much lower.
Right. I mean, of course, the Fed is policymaker, so they can make up their own mind. And like all humans, they can make mistakes. So, but bond yields are reflective of market conditions, and you'd think if there was a mistake, it would sniff through it. So in your sense, why do you think we get to the low threes?
So one of the really key things about the underlying level of interest rates is not just what's going on in the US, but what's going on in the rest of the world. So the rest of the world is having influence on real interest rates and expected inflation both. It hasn't had a huge impact so far because the US economy has been so dominant and so strong no matter what. So the real key answer to your question, I think, is will the rest of the world stay weak? Will Chinese growth continue to disappoint? Will Europe stay just very weak? I don't mean it just getting worse and worse and worse and worse. Then, of course, everyone knows what happens. I mean, just having an extended period of malaise, a slow burn, we would call it. So that's point number one. Now, the big shift, if that's the case, because it won't be a huge change in the underlying backdrop of China or Europe, if that's the case, the US is really where you're getting the big shift. And so the key thing here is that if fiscal policy is shifting, and that's the change in fiscal policy, not whether the budget deficit stays big, it's the change in the deficit and whether the current level of monetary policy settings is restrictive. If it's restrictive, then it gets worse and worse and worse for the economy. It's completely different between monetary and fiscal policy in terms of the lag. So this kind of differential lag between monetary and fiscal policy and what happens in the rest of the world, that's what's going to drive whether growth is below expectations or not.
So, I mean, what are your thoughts on fiscal? There hasn't really been any fiscal restraint, for decades. And part of that was a reflection of the fact that policymakers had finally bought into the fact that we live in a world that was very deflationary. And certainly when we had the financial crisis in 2007-8, the world was very deflationary. If they didn't act, we could have gone back to the Stone Ages. But then during pandemic, we saw 3 times as much monetary stimulus and fiscal stimulus as we did in 2007 and 2008. And certainly, you could argue that things didn't look as bad at that time. And then even once we'd started to have expansion, we got even more fiscal stimulus. And we had fiscal stimulus during the expansion of Trump. So fiscal stimulus had become counter-cyclical and pro-cyclical. So what's it going to take to stop the spending machine?
Right. So it's very important to think of what's your time horizon. Mm-hmm. So if your time horizon as an investor is the next 6 or 12 months, is totally different than a pension fund or family office that's 5 or 10 years out. If it's the next 6 to 12 months, it's the change in fiscal policy, and it's going to be very difficult for fiscal policy to be stimulative over the next year because it was already so stimulative this year, and because the interest payments are going up so rapidly, and that's not a stimulus. They're just shooting up like crazy right now. And so the change in the cyclically adjusted budget deficit, which became very stimulative in the second half of this year. It's extremely rare for that to happen when the economy is not in recession. The primary deficit widens substantially. It almost never happens outside of recession. It did happen the last few quarters, and it gave a nice boost to the economy. But now it's the change in that. So you need to have the deficit getting wider and wider and wider every quarter to have a stimulus. Probably it's actually going to shrink. Or if it expands, it's because the economy is slowing. So that's point number one. Mm-hmm. Point number two is you mentioned this, I don't even know if I'd call it fiscal irresponsibility, but over the last, certainly since 2008, but you go back maybe 25 years, this idea that when the economy weakens, the fiscal policymakers can be, in quotes, irresponsible without any punishment whatsoever because private sector savings is going up very sharply in the world that we've seen in the last 20, 25 years. People get scared, they start saving, businesses get scared, they start saving, and if you don't get a lot of stimulus on the fiscal side, the economy really starts to crater. And that's the issue. Japan is the classic example there. Something changed. So number two is that whereas before bond yields and fiscal policy, when fiscal policy was easy because the economy was in trouble, bond yields would fall. That's what happened in the first year of the pandemic, for example. And it kind of lulled policymakers into thinking, okay, this is just completely normal. This is always going to happen. And as you said, Joe, so that, when the economy's okay, we can stimulate. When the economy's weak, we can stimulate even more. We just keep stimulating. And so there's a huge question right now as to whether the private sector is just going to be really scared and always trying to save, which of course has certainly been the case since 2008. And if it's not the case, not really an issue for the next year, but if you go to that further out time horizon I mentioned, between over the next 5 to 10 years, and you have this constant desire on the part of governments to finance the green transition, finance increased military spending in a very uncertain world, finance increased infrastructure, which in the US is really, really bad. All of those things, trying to do it at once, it starts to feel like the 1960s when the government really blew out its budget deficit to pay for the Vietnam War and to increase the social welfare state under Lyndon B. Johnson. And that's where you run into that big debt trap. And the debt trap the debt arithmetic, for those of you listening that are familiar with the debt arithmetic problem, it's when the interest rate gets higher than the underlying growth rate of the economy, you can run into really big problems.
Well, Couldn't you argue that right now the US is in a debt trap? I mean, by traditional definition, uh, debt is over 100% of GDP. And at least from a forward looking sense, in terms of, Alpine forecasts, interest rates above the growth rate.
At present, real interest rates are probably below the growth rate or equal. It depends. Of course, in the last quarter, the US economy grew almost 5%. But let's just say the underlying growth has been maybe 2 or 3%, and the 10-year TIPS yield is just over 2%. So, but that's not really the question. The question is, if over the next 5 years, the real interest rate, the long-term real TIPS yield, for example, or what the government pays to borrow, in quotes, risk-free, versus the underlying average growth rate, not in any given year or quarter, but if it's persistently above and they don't shrink the primary deficit, that's when you have to really start to worry about an ugly situation. So right now, it's not particularly brutal because they got these spending plans, but also the underlying economy is showing a lot of vigor. Okay, the real interest rate is up higher, but if the economy starts to weaken and that real interest rate does not come down, that'll be your first warning. So we definitely don't expect that next year, but maybe over the next 3 to 5 years, that's exactly what will happen. The bond vigilantes will come out and say, I don't care if the economy is weakening, which usually pushes down real interest rates. I don't trust these guys. This is starting to smell like Argentina or Latin America of the 1980s. I don't want to hold those bonds. That's what to watch for.
No, that certainly it certainly makes a lot of sense. So you think structurally we're not on the path towards crisis? I mean, will it take a crisis for policymakers to change their mind? Because if we're not in that situation, then it's really beneficial to a politician to spend because you get the immediate benefit, whereas the costs are more long term, and you have to follow an electoral cycle. So, will it take a crisis to change things, which could be a financial crisis where the bond vigilantes basically say, we're not going to finance this anymore, and then the numbers don't make sense? Or will they just one day wake up and smell the coffee? What are your thoughts there?
So I think the scenario that you want to look for is a crisis, but there are lots of possible drivers of that crisis. So you mentioned one where the government says, we're just going to keep on spending. Like, we have too many priorities. We have to subsidize onshoring. We have all the green transition, the adjustment to do with the military, the new, more scary world. There's all kinds of places where we need to be supplying weapons or else there will be instability in a growing number of regions of the world. That's one possibility where politicians say, I can't cut it. I would like to, but there are too many chunks and I don't have the guts to cut entitlements because that's political suicide. That's a recipe for a major crisis, of course. But the other possibility is that in the rest of the world, the supply of savings becomes less plentiful. So if in the rest of the world, for example, China, which has been a massive supplier of savings to the rest of the world, their domestic economy is extremely weak right now. They are supplying savings to the rest of the world. There's upward pressure on their current account surplus because they're just producing way more than they can consume. They have a huge confidence crisis, et cetera, et cetera. And so even though China is having economic difficulties now, that's pushing up savings, they've been providing savings to the rest of the world for quite some time now. What if that changes? What if people start to say, wait a second, I'm going to sustain my standard of living by borrowing in China. And the current account deficit, the current account surplus in China starts to shrink. And that puts upward pressure on real interest rates, not just in China, but in the entire world. If that conflicts and starts to come head to head, not just with US government spending, but also spending in the rest of the world, then that's a clash. So people, I think, mistakenly say, well, no, what I'm really worried about is that the Chinese authorities, who have $3 trillion worth of foreign exchange reserves, that they'll decide they don't want to hold any more US assets. That, of course, is possible, but that is not really a major concern, because what that would do is cause their currency to go through the roof and be highly problematic for them. Plus, what would they do? Or would they just sell those dollars and put them into domestic money? Well, then you'd have a massive domestic inflation. That, as far as I'm concerned, it's just a very weak argument. The stronger argument is if China starts to consume its own savings. So those are the two big, I think, drivers of a possible lender strike and crisis.
Okay. So nothing on the immediate time horizon. No, the reason why is because I think that our viewers are quite interested in this topic, from a tax point of view, and also a fiscal irresponsibility point of view. And if you think about things big picture, whether it's the US or the world, after the financial crisis, we saw a lot of deleveraging. And so if you look at the US households, they don't seem to be particularly indebted. Corporates in pretty good shape. And that can also be said, on a global basis. But if we look at total debt, it really hasn't gone down $1 in the US or globally. So we've seen private sector deleveraging and public sector leveraging, so that the system as a whole really hasn't deleveraged, which might be one reason why the private sector has been so resilient to the very substantial increase in rates over the last couple years. So I think it's really a question of the path and how the public sector would deleverage. So your thought is, over the next year or so, not much happens, but there's a little bit of less fiscal stimulus, which should be lead to a slowing economy and declining interest rates. Over the longer term, there are potential for a crisis, and that could either be, a Chinese lending strike or just bond vigilantes saying enough is enough. Is there any third path?
Well, if you're worried about a crisis, I think those are the two really main things that you want to look for. The third possibility, which is not, hopefully it's not going to happen. And I can't really, it's a geopolitical, something that happens geopolitically. That when there are wars, usually that leads to a period of inflation and massive government bond issuance as they try to finance just very, very extreme military expenditures, not of the type that the US has had to deal with really since World War II, where they've dealt with initially the Cold War spending, and then as a hegemon. That's not really what I'm talking about. I'm talking about a very major expenditure, a very significant one. And so that's a third possibility too. Hopefully we will not have to, even think about that. But of course, that's historically how inflation's happened. So those are the two main possibilities for a crisis or a lender's strike. But there could be a lot. There doesn't have to be a big debt crisis out there. It's a risk. It could just be that there's a phenomenal productivity boom to do with those technological breakthroughs that made you wonder if I'm a robot or not. That's something. Not only does it put a cap on inflation, massive cap, very hard to get inflation when it's so easy to replace people and increase the productivity of people, but also it makes it a heck of a lot harder to get upward pressure on real interest rates
Right.
as well. So I don't want to give you the impression that this is baked in the cake just because governments are always responsible. We had many years where governments and politicians were following the same incentives they always did, and we had a massive bull market in bonds.
And just bringing things back into the nearer term, you brought up a few scenarios at the start. So if we go back a year, pretty much everyone was wrong on the economy. A record number of forecasters thought that there'd be a recession. And so maybe tell us about some of the puts and takes in terms of the forecast for the coming year. Do you think we'll enter recession? It sounds like even if we do, it's a shallow one, but gun to head.
Sure. So gun to head, I do think the US will go into recession. And I think part of the reason I think that is because the economy just was unusually strong, and that was unusually dependent on things that were temporary. Those two things, I've already mentioned fiscal policy. It's the change in the structurally adjusted deficit. You can have a really big problem budget deficit, a really big one like US has now, and if it sits there big, it's not a stimulus. It could actually even be restraint. So that's like the number one thing. The other one you mentioned has to do with the consumer and their balance sheets. And so what we got with the latest revisions of the household balance sheet data was savings were revised up by $600 billion from what we thought. Those were benchmark revisions, very important. And what that says is those COVID subsidies and the improvement in household balance sheets that occurred as a result of them, which we thought and Jamie Dimon thought and everybody thought sometime in the second half of this year, they would be used up. And it's a one-time thing. It's a stock, not a flow. Now it's like, okay, it's the first half of next year. $600 billion is not chump change,
right,
but it doesn't buy you 2 years. No way. And so what we are starting to see right now, and this I think is more direct answer to your question, is delinquency rates rising, banks, not necessarily all financial institutions, but banks, especially regional banks, not only are they tightening their standards, but they're looking to stabilize themselves. The ones that are, they didn't go bust like Silicon Valley Bank, but they've had stress associated with their deposit flows. The way that they are going to restore credibility, it's very clear what their plan is. They are going to shrink their balance sheets.
Okay.
So you can see that if you look at M2 growth, you look at bank credit, they're both contracting. They're down year on year. So it's very hard to make the argument that, well, if the Fed doesn't hike rates anymore, then the economy will be resilient to that. It's a very hard argument to make. It's very easy to make the argument that if they don't cut interest rates in the next 6 months, that the economy will be under greater and greater wear and tear. And so I'll just also add, and this is a question mark for sure, but what has happened in labor markets in the last 3 months anecdotally is the workers that got the best wage gains coming out of the pandemic were in relatively low wage, low skill, low experience services jobs. Makes total sense because coming out of the pandemic, you didn't have enough of them, but that is changing very quickly. And so there's lots of anecdotal evidence right now from different companies that we speak to that they don't have a problem getting those workers. We can also see it from like 30,000 feet up when you look at labor force participation rates. People like my age, 62, that participation rate is not going up to where it was before the pandemic. A lot of my friends are retiring earlier than I expected, for sure. But if you go to the 25 to 55-year-old, that participation rate is now above where it was before the pandemic. So labor markets are relatively loose. We've seen this in wage growth. It peaked in most segments of the labor market a year ago, even without the economy weakening.
If we look at the labor diffusion index, then really the only sectors where employment is showing decent growth are the ones that are still having this post-pandemic adjustment, and they're largely low-wage areas, tourism and hotels, teachers, some people in healthcare as well, whereas the broad economy is not showing much in the way of employment growth. So what about QE? It looks like, and I know it's your forecast, that at least the Fed is done raising rates. Are they done with QE, and how does that play in terms of rates and monetary constraint?
So I used to think it was very simple. The idea was that unless interest rates were zero, or I guess below zero, we now know they can go below zero for short periods. Unless interest rates were down to zero, what the Fed did with its balance sheet really wasn't particularly important because interest rates were the binding constraint. The whole thing about quantitative easing was it's a desperation measure. Interest rates get down to zero, the economy's not responding. What do? You try to manipulate what investors and people want to do. You try to get them to take risk when they don't want to take risk. You force down further and further out the yield curve. You force down the structure of risk-free interest rates so they start taking risk because they can only get zero on a 10-year bond or something. I used to think it was that simple. And so I think it's a little more complicated right now because there are some signs that quantitative tightening, which is what the Fed has started to do. They're started to try to shrink their balance sheet, even though raising interest rates is the main mechanism by which they're tightening, but they're also nervous about this fiscal stimulus. They want to get their balance sheet down so they don't sacrifice too much credibility. That quantitative tightening at a time when regional banks are having problems getting deposit flows because interest rates are very high and it's really pressuring their spreads a lot, that's probably adding on another layer of tightening. So I would expect that the direct answer to your question is that they're going to continue to do that because right now, today, the Fed is not worried about recession. They would love an economic slowdown. They would love to see the unemployment rate get close to 5%, which they still consider to be quite low. And so quantitative tightening helps them to do that. A strong dollar helps them to do that. Tightening bank lending standards, as shows up in their quarterly survey, they like all that. But what we've learned in the past is these things can change very quickly. And the underlying backdrop, even though real interest rates are quite high, and maybe that's part of your concern, Joe, that part of it is this is new world where bond vigilantes are not going to let real interest rates go down very much. But what we do know is that inflation expectations right now and actual inflation, it's just extremely well behaved right now. And so if you get an economic slowdown and inflation expectations start to go down, they could easily get into too low zone again, which the Fed is not expecting. And so quantitative tightening could very, very quickly reverse to quantitative ease.
Okay, that's fair enough. And I mean, to me, makes a lot of sense. So how does this macro outlook play into the AI potential mania or bubble or what have you?
Sure. So I've done a lot of work on this whole idea of these 7 stocks, the Magnificent Seven. And for those of you that are really old, if you remember the Nifty 50 stocks of the early 1970s, there were 50 stocks that were considered to be just these amazing companies. And so as the underlying market started to crater in 1973 in the first oil shock, 50 stocks of these 50 amazing companies, they didn't peak out until much later. The breadth of the market, it just started to fall. And so a question you want to ask yourself, put another way, is these Magnificent Seven, could they be like Nifty 7, where they're amazing companies, they have incredible moats around their business, phenomenal margins. Since March 2020, those 7 companies in the S&P 500, those 7 big tech companies, they've expanded their margins by 4 points. And since March 2020, the whole rest of S&P 500, S&P 493, if you want to call it, those margins have shrunk by 2 points. So what I'm saying is they're great stocks. But in the past, you've had these great stories that really fit the times, and they go into crazy, unjustifiable valuations. And that's what happened with the Nifty 50. It happened with the large cap tech stocks in the late 90s, like Oracle, Cisco, Microsoft, Intel, Dell. And that's what you have to worry about. The multiples right now for those 7 stocks, although the forward PE is still quite high by the standards of your basic company, they're the lowest they've been in 10 years, that forward PE. So the mania type story that we would be concerned about is go to the Charles Kindleberger bubble framework, which has been very, very helpful to understand what happened in Japan, with gold in the 1970s, with the tech stocks in the late 90s. Very different financial assets, but they all fit the following framework. They have 4 things. The first is they're real. It's not just this smoke and mirrors thing. They have something that is truly compelling. It's a truly compelling, usually a macro story, like gold in the 1970s was. It was just a phenomenal inflation hedge. You couldn't print more gold. There was they call displacement. So of course, with these big tech stocks, there's already been a displacement. They're already amazing, but clearly AI is something that a number of them can really take advantage with their big data and the amount of money that they've been investing in research, et cetera. It's real impressive. So there you go, number 1. Number 2, extremely difficult to value because you're in a new world. And that convinces people to say, the old people don't understand. You can't look at traditional valuation metrics because this is new. This is amazing. We've never seen it before, and you need a different metric. So in the late 90s with the internet, it was like, well, these companies were always going to lose money for years, and we know they're worth a lot. So let's just look at the number of people that are going to their website and value them on that basis, so-called eyeballs. And so in the case of these big tech companies, you could get into a situation where the forward multiple goes up to like 80 or 100, like the Nifty 50 stocks got to, which is totally unjustifiable for these companies because they already dominate their sector. So it's the difficult to value check mark. The third thing is broadening participation, usually the retail crowd, where you get a number of investors and they get very excited about the story and their neighbors are making money or their friends are making money from it. And they're not too worried about valuation or gravity or anything like that. It's just, are they exciting? I'm going to buy more, but I'm not going to take big chances. I'm going to wait for corrections. I'm going to buy the dips. And so I think that really that mentality is in the early stages of being created for these 7 companies, because what happened was in 2022, those big tech stocks started to correct as the tech capital spending cycle started to move down, and they had overhired and overpaid. And so they got hammered. And the people that were not in those stocks, they felt great for about 3 months. And then those stocks started to recover, and any money manager that was benchmarked to the S&P 500, their tracking error was massive if they weren't in those 5, 6, 7 stocks. And then the regional banking crisis hit, and the big tech stocks went through the roof because they had massive cash reserves and very little debt. And so people became convinced that, oh, they're growth stocks, oh, they're market leaders, and oh, they're also defensive. You can't lose. So check mark for number 3, retail investors and money managers that don't want to have a lot of tracking error with things like the S&P 500. That's broadening the participation for sure. And then number 4 for Kindleberger is plentiful liquidity. And we don't have that right now. And so if the Fed starts to ease, if there's more generous money growth, or if money growth relative to underlying economic needs for bank credit starts to go up, that money could really feed the flames of a real historic mania in those stocks sometime next year. And that's exactly what happened in the late 90s. It's a longer story. I know we have a shortage of time, but certainly for those of you that remember the Y2K problem, which didn't turn out to be a problem. But the Fed flooded the system with liquidity in 1999 because they were concerned there would be a computer bug, January 1st, 2000. And that money created a phenomenal upward pressure in any tech stock at that time. That's what we could look for next year if the Fed is in easing mode, and there's not an inflation problem.
Okay, and switching tacks, maybe limiting things to 2 or 3 minutes. You've liked traditional energy for some time. Northland bought into that earlier this year, and our clients have benefited spectacularly from that. We believe that this is an intermediate term story. I know more recently you might have warmed up a little bit to some of the energy transition and the new energy, which we have zero exposure to. So, at this juncture, what do you favor? Traditional oil stocks or some of the newer, greener versions?
Sure. So we definitely favor the fossil fuels. Full stop. So I know I want to keep this real short, but anytime there's a US recession, every single time, not the 1970s, because it was a supply shock, but every time since, we have the chart, oil prices go down. $10, $15, $20. If it's a mild recession, way more if it's a serious recession. So we expect a mild recession. This is not going to be a nice, smooth upward move in oil prices, but I really like the way you put it, Joe. Intermediate term correction. We've had some dollar strength. We've had an easing in the geopolitical risk premium because what's going on in Israel and Gaza has not escalated, at least as of now. Of course, that could change in a minute, but it hasn't. And Hezbollah and Iran so far have not shown signs that they want it to escalate. And that takes the geopolitical risk premium right out of the oil price. As far as I'm concerned, that can give you dynamics 3 months, 6 months, for sure it can, especially with a strong dollar, but it doesn't change the medium-term story at all. And the medium-term story is very simple. It's very expensive to make this energy transition. It's very costly. And if the world economy is weak next year, governments are going to get really, really nervous about these big subsidies that it costs to do the climate transition, green investing, all this kind of stuff. And if anything, it's going to slow down. And this is what we've seen with GM, for example. The EV infrastructure network in the US is just simply not appropriate for a big rise in EV sales. You have to make a massive investment. Other places like China are much further ahead, for sure. It's not like the story is going to reverse, but you're going to need lots of oil 2 or 3 years from now, and it's not incentivized. Plus, you're seeing possibilities, we'll see, but pretty good possibilities that US shale production is peaking, even in the Permian, and even the possibility that Russia is having trouble boosting its production because they may be running out of parts and sanctions. We'll see, but that would be a major problem for oil supply.
Yeah, our view is, assets are attractive, at a certain price. And I think that for EV, there's too much non-economic money coming in. In other words, government money, which means that the projects themselves don't necessarily have to have a positive return on capital. And that's led to too much money chasing too few projects. And then we've seen interest rates and costs go up a lot. And so from what I'm hearing among some of the bigger players in that field is there's a lot of projects that are just uneconomical right now. And there may be a wave of defaults over the next few years. And then when you see that rubble, long term, there's some very positive things. And I think it'll be attractive, but not now. And our thesis for traditional energy is a little bit different. We do see demand structurally declining, but we think prices will not only at some point take out 150, but to something on declining demand because there won't be any supply. It just doesn't make sense for these guys to explore. So in other words, without spending much money, they're going to get higher and higher revenue, just like we saw in tobacco in the 1980s. The sin stocks were the best performing sector, even though demand was declining and they were almost being taxed out of existence. So our thesis is the thing to watch out for is that governments, put on some of these taxes like we've seen in Europe. So far, we're not seeing them in North America, but this is part of our long-term thesis. So maybe to close out, what is your number one non-consensus idea for 2024?
Sure. So I think if I was to talk about investments, it would certainly be that big tech idea, that the major overshoot. But I think probably more valuable for the listeners is what's going to happen to inflation and wage growth. I'm not talking about a collapse in margins or anything like that. I'm talking about next year, it could easily feel like 2% inflation is too high again. You remember the Fed missed their inflation target 8 years in a row, below 2% every single year. And so one thing for all of you to watch for is inflation of 0% next year, just a real collapse. And the reason I say that is there's two parts to inflation. I mean, there's a lot, of course, but you can split it into two parts. The San Francisco Fed does it. The part of inflation that moves with the business cycle that the Fed can kind of directly influence by influencing the economy, and the rest. And the rest is driven by like technological innovation, healthcare, globalization. Long wave has nothing to do with the business cycle. And that got up to, I'm trying to remember, the peak got up around 8% about a year and a half ago. And now it's falling very sharply. And this doesn't have to do with the Fed or the economy. It's just an underlying residual. And so that's already falling. If we get an economic recession where the cyclically sensitive stuff goes below 2%, you could have much, much lower inflation than people think. Now, if it's in the context of a more severe recession than we expect, then you're going to have a big problem in the stock market, and stocks, which have outperformed bonds by about 2,000 basis points this year. Maybe bonds will outperform stocks next year by 2,000 basis points. That's not our view, but watch out for an almost complete evaporation of pricing power. That's what I would be looking for. I don't know anyone else that's looking for that.
We're pretty close, but we read Alpine Macro Research, so maybe we're biased. I mean, our view is inflation is already below Fed target right now. If you kind of annualize even the last 3 months, not just 1 month numbers. So we certainly have a view, consistent with that. So, maybe I'll summarize and you can chime in if I've missed something.
Sure thing.
So Dave is looking at bond yields getting down to 3%. And the idea there is the economy is going to slow more, and we're going to go from kind of fiscal spending being stronger to a little bit weaker, which moves fiscal thrust into a negative position. The only piece missing for the AI bubble or Magnificent Seven or what have you to really blow up is kind of easy monetary. So if that plays out, we get cut in interest rates and maybe at least no quantitative tightening, maybe quantitative easing, then this bubble will really move into full throttle. Regardless, we're going to have maybe a cyclical 6 to 12 month period of weakness in oil prices, but this is a temporary setback in a structural bull market. Dave has his views and we have our views, but they both agree. And if we talk a year from now, then our listeners will be most surprised, and Dave's competitors will be most surprised by maybe possible deflation. Did I capture anything, or did I miss something?
Oh, that was fantastic. Yeah, I very much agree. And so one thing that we didn't get into is what's going on in China. And if China continues to have a slow burn, not a meltdown, but they just have great difficulty growing over the next 5 years, that greatly increases the chances of everything that I said coming true.
Okay, thank you so much, and we'll chat again soon.
That's great. Thanks for having me. Good luck to everyone.
Okay, cheers.